FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz, and today is May 29th, 2018, almost halfway through the year. Where did it go? Hey, I don't know, but my favorite activity in the morning is reading your emails to me. I'm only about 30 or 40 behind, which ain't too bad. That's like half a day's supply. So feel free to drop one off on any subject that grabs you. The email address is kl@kerrylutz.com. So you know that we're late in this bull market. You know that if you're an active investor, you got to start finding new ideas, which really is a good thing, because when you think about it, when you keep doing the tried and true, you get tried and true results, which aren't always the results that you want. Jason Stevens of Sprott Asset Management is with us now to talk about a few areas that have high profit potential with extremely low risk. Jason, welcome back. It's great to have you back on.
Thanks, Kerry. Always great to be here.
Hey, so we got like a bull market that's late in the cycle. Obviously, you can't just pick an index, any index, and just put money into it and watch 25+% returns accrue. You got to be a bit smarter at this point in the cycle, don't you?
You sure do. One is because obviously these bull markets and these late cycle economies can last longer than maybe the contrarian necessarily wants it to or prefers it to be. So having that longer term investment horizon and focusing on valuations is something that we do specifically for the fact that we want to reduce the amount of downside due to cyclicality and all of the upside, and take advantage of all of the upside of the same cyclicality on the way up. So yeah, absolutely. This is something that you need to focus on all the time, but certainly the market is ripe and looking for a reason to shift, like we saw in February with all the volatility that we saw.
Yeah, so there's certain sectors, though, when you're this late in the market, obviously the consumer stocks aren't real appealing, and you need to be really revamping things. So what are the sectors, and what sectors at this point look good, if any?
Yeah, so obviously the predominant late cycle industries are commodity producers. And in fact, Wall Street Journal, give them credit, they did a very good article in April 2017 about late cycle investments, and they mentioned commodity producers as a whole. Now, I think at this point, the opportunity lies on kind of the periphery of these industries in kind of micro markets that have lower valuations than we've seen in a long time, let's say probably a decade. And one of them is dry bulk shipping. Dry bulk shipping, basically moving stuff like coal, iron ore, and soybeans and soybean meal, those sorts of agricultural commodities. That's the first one. So I'll go through the list and then we can talk more in detail. The other one is Canadian energy, and that focuses on the range of Canadian energy companies. So exploration, production, the midstream, and then the service providers. And then the last is the fertilizer chemicals. So potash and nitrogen and ammonia type chemicals, and then to a lesser extent, the phosphate rocks. Mm-hmm. So those are the three main ones that I see benefiting, but dry bulk shipping is top on my list mainly because of the cyclicality that we've seen over since the bull market of the 2000s. We had a huge overcapacity build, but we had also a lot of regulation near the end of the decade, both on the banking side to reduce leverage that can be provided to the ships, and then also the environmental side with how these ships can actually burn fuel, and the historic fleet has to actually change. And so there's a lot of the demolitions that we're seeing are picking up because the market is so underpriced. The assets are underpriced. We've seen the day rates on dry bulk shipping go from, on the index, which is the Baltic Dry Index, go from the average day rate of all of the ships from over 10,000, and then at the low hit a low of something like $250. So basically a 95% drop in that market.
That's pretty remarkable. So one thing, going back to Canadian oil producers, they have taken, they've really gotten hit badly, especially under the government's open hostility towards hydrocarbons. And, the fact is, for the foreseeable future, the economy in Canada, the U.S., and the world is a heck of a lot more dependent on this aspect, on this energy source, than Trudeau would like to admit. I mean, this is a little short-sighted, isn't it?
Well, the environmental side is definitely short-sighted. However, I think the big discount that you're getting between the U.S. and the Canadian producers is coming because of the lack of transportation to access global markets for the Western Canadian sedimentary basin. So obviously, most people had heard the Keystone Pipeline has gone through its own regulatory issues and, limited and delayed builds and all sorts of things. Well, there's another 2 or 3 pipelines that have been delayed or not approved. And then there's also a series of things that, and mainly takeaway capacity, that limits the ability for that Canadian oil and gas to get to foreign markets. So it's not it's not keeping up with the recovery that we've seen in oil and gas prices globally or even here in the U.S. So there's a huge spread and differential between the Brent and WTI markets and what the Montreal and Alberta markets are providing to the Canadian producers.
Yeah. So this sector has really gotten wildly oversold, hasn't it?
Yeah, I think not only did they suffer from the drop in oil and gas prices, but they haven't been able to recover because of these takeaway issues. So what you're seeing is valuations that we haven't seen since oil was $10 or $20 a barrel in the late 90s, early 2000s. On what they would call an author calls the takeover metric, the EV or enterprise value over EBITDA, or earnings before interest, tax, depreciation, amortization.
So is that a result of the very negative economic business climate in Canada? Is that part of it? So is that being overblown, or what are we seeing?
Yeah, well, so it's kind of a chicken or the egg issue because Canada is so dependent on oil and gas. So you're seeing places like Alberta, places like British Columbia, and that benefit from all of these resource markets that aren't getting that revenue, which puts pressure on politicians to do things, but they don't have the money to do them because tax revenue is down.
Right.
So the cyclical thing that the government needs to, one, I would prefer get out of the way, but two, there has to be a way, and there are ways that private industry, like building LNG plants to liquefy the natural gas that's being produced in the Western Sedimentary Basin and then get it to foreign markets. So that's one way. And then these pipelines is basically, we need to figure out something with the groups that are in that are creating static. And one are always governments, but two are always, the multiple dealings with the First Nations groups in Canada. Mm-hmm. So, and don't get me wrong, these are all negatives, and they're headline negatives, so they're priced into the market. I think that if you own the best and highest quality producers at these low valuations, you'll benefit, and that's why I'm kind of highlighting it here, is because I think that getting these companies lowering their cost structure, just like the dry bulk industry, just like the potash industry, when you go through a downturn of these magnitudes, you have to cut your cost structure of the business so you have operating leverage on the upside.
Right.
And that will happen eventually. It's a matter of, does the business and the investment that you own take advantage of that? Or are they going to peter away and lose all investors' capital before that recovery happens?
Uh-huh. So...
that's why focusing on the quality is actually a risk reduction strategy and not a maximize the upside. I think there's going to be more than enough upside potential to justify the risk you're taking. You just need to have a time horizon that's long enough to realize that benefit.
Mm-hmm. So you have to be patient in this case, what I hear you saying. And you got to play quality, because you can't. This isn't a time you should be speculating, hoping that risky, Canadian oil company is really going to pay off finally, right?
Well, yeah. I mean, that's not what I do. I think that if you're talking about investment worth speculating, or investment versus speculating, you're really talking about, a longer term versus shorter term approach. And my clients pay me to make a very risky and cyclical business less risky, not to maximize every dollar on the upside. If I'm more likely to continue to take speculations on companies that have low returns in average markets, well, that means most years I'm going to underperform if you average it out. If I'm trying to be tactical and buy and sell timing wise, I'm not doing the full best for my client, because those are transaction costs, those are friction costs, all sorts of things that eat into returns. Whereas in this sort of environment, when I can own the best and have a higher likelihood of a risk-adjusted return, that's what I'm paid for, is longer-term success, which is longer than the average investment horizon, which seems to be getting shorter and shorter as we have more technology that allows us to trade cheaper and cheaper.
Yeah, exactly. So looking at uranium, which we've been waiting for uranium to pop for years now, since Fukushima, it's really taken a major hit. And yet China keeps building more nuclear power plants. More plants are built around the world. And something's got to give here, doesn't it?
Eventually it does. And I think the spot market, which has been oversupplied by certain parties, that supply is coming offline with the cuts from Kazatomprom, the recent cuts from Paladin on another, top 10 producing mine. All of these things are spot market, or these companies were providing production to the spot market. And that is really where you're seeing that $20 per pound price. So as you see that supply getting cut back, and you start to see Cameco, who has also cut their production, but has to provide uranium to the long-term contracts that they have with other parties, they're basically making up the production shortfall they have by buying in the spot market. So now you're having a reduction in supply in the short term to the spot market, and you're having an increase in the demand from Cameco to provide to the long-term contracts. So eventually those contracts will fade or expire, and my expectation is that once that happens, we'll be at a higher spot price and a higher long-term price, which will justify, the better companies to re-sign long-term contracts at a price that, makes sense. And, some of these guys can recover some of their cost of capital that they've lost over the last 5 years.
Yeah, well, I find it interesting that you have a major player who's now arbitraging the spot market because they can buy it cheaper in the spot market than they can produce it. Anytime you see that, it's got to drive the spot price higher, right?
Well, you would think so, but they've been doing it for a while now. They just haven't been doing it to this extent until they cut MacArthur River. So it will it will speed up the process. But one thing that we're also seeing that's interesting is that I believe it was confirmed that Kazatomprom is going to attempt to do an IPO later this year. And that, if they're taking a note out of the Saudi Aramco playbook, then what they're doing is they're prepping the market to go public and get the highest price for their shares in the IPO. So is that timing that we're seeing all of these production cuts part of that process? And are they a big enough player in the market to have that affect all of the long-term and spot markets?
Well, it's a wonder why others haven't followed suit, isn't it? Because if you can buy it cheaper on the spot market than you can produce it, you're effectively losing money in that differential, right? Because nobody can produce.
Yeah, I mean, absolutely. And the biggest problem with these mines is that they have contingent liabilities that make them continue to produce. And obviously the regulatory environment and the environmental liabilities that are, if you put something on care and maintenance or if you shut it down completely, all of these are issues that these are company destroying or company making decisions. So they're not taken lightly. And that's why it's taken this long after, a full decade for a lot of production to come offline. And so that's, absolutely, it will correct itself. And we just don't know, what the catalyst will be. Some people think it's the Japanese restarts. Some people believe that it's going to be the new Chinese reactors actually starting to buy inventory. But I kind of think, and I'm in the camp of, I think it was Nick Hodge that said this, that nobody wants to be the first to make that first long-term contract because build off that.
Right. Yeah.
And they will spark that competition, and you'll immediately, I believe, see the spot price move up.
Yeah, once they haven't renewed yet, right? All these utilities, we got 100-something plants here and around the world have just held off renewing the long-term contracts. Isn't that kind of irresponsible for a major utility to put their future supply costs at risk?
I'm going to steal some knowledge from Rick, my boss, basically saying that I guess you could see it as irresponsible, but you could also see it as these utilities have a number of different priorities, and because the actual inventory of uranium, what the cost of the uranium is such a small part, and they have such low price sensitivity to the inventory, they don't care if they pay $50 or $150. It's really not a big input cost to to the cost of their kilowatt hours in whatever country they're producing electricity in.
That's very true. Really, it's the fixed cost of the nuclear power plant, and it's kind of like that's just the battery that runs it. It's kind of like how much silver is there in your iPhone. Really, it doesn't matter to them whether silver is $100 an ounce or it's 16. Either way, the iPhone's going to stay pretty close to the current price. But on the other hand, if there's a supply squeeze and they got to pay a lot more, well, hey, I guess they just pass it on to the rate holders, right? The rate payers.
Absolutely. And can they cut in other spots or during the operation cycle, the production cycle, the enrichment cycle? All of these things are unknowns that they can adjust for. But, these are things that they don't see until they see a catalyst in terms of the price. They don't really have a need to replace their inventory. And what may be a catalyst, like I said, is the buying from the new Chinese reactors, which, the big problem that I've seen is that the buying happens every 10 to 15 years because they buy that much inventory for a nuclear reactor, and then they don't contract again for that period of time. So it's cyclical because once one party buys, they all buy, and then they go quiet for the next 10 years.
They're like lemmings going off the cliff, and I totally get what you're saying. It's the same thing with like catalytic converters and auto companies, palladium and platinum. You see this in a lot of industries where, in terms of the industry itself, their consumption makes a big difference. But in terms of the underlying consumer, it's the tail wagging the dog. It just doesn't matter. Hey, just go back for a moment to fertilizer. So agriculture's had a tremendous run up. Wheat prices near record, soybean, etc. I don't know that much more land, arable land, can be added to the world's supply. But if you're gonna try to increase your production or expand your acreage in production, then obviously this is a good time to be a fertilizer company, right?
Yeah, and the fact that the applications over the last 5 years has dropped so much because of profitability from the farmers, they need to reapply some of these things because they've pushed their input costs into the future to the extent that, they want to grow their yield to keep up with stuff like population growth and increased grain intensity for stuff like cattle. If they want to keep up with that demand growth through yield, they need to apply these fertilizers or they will be depleted and they'll miss out on multiple years of higher production. So potash is, I think, the one I would focus on, but a lot of the major and higher quality fertilizer companies have both ammonia and nitrogen production and potash. So those are the companies that, again, they're off their bottoms, but still you haven't seen the shifts to farmers' habits and tendencies to replace their inputs fully take effect yet, mainly because corn and soybeans that have recovered recently, that affordability between the higher revenue coming from those commodities and the relatively lower cost of potash and different fertilizer inputs, that spread hasn't been recognized yet. And over time, if that spread stays that way, it will. But other costs have been rising on the farmers as well. So that's anything that puts profitability for the farmer under pressure will hinder the amount spent on fertilizers.
Yeah, well, but for now, the farmer is booming. Fertilizer costs are significant, but they're not that high in comparison. Energy costs far more significant input, right?
Right. And they are, but remember how important they're going to be if you think of lost revenue in the future. Mm-hmm. So if you have a farmer that either wants to grow or hasn't fertilized or hasn't kept up with the crop rotation or depleted mm-hmm. more so in the last few years, which most of them have, than they had in the prior 5 to 10 years, they need to focus on, running the firm. And if there's any gross margin, they have to reinvest in their land. They are basically their own tenant.
I gotcha.
And their own business owner.
That's so logical. It makes so much sense. And they've gotten a big boost from technology recently, which has really spurred production. So maybe they're getting to the end of that cycle now, and maybe we're just going to see more of this type of thing going on in the future. Anyway, Jason, if we want to contact you, reach out to you, where is the best place to find you these days?
Well, you can reach out to me directly at jstevens, Stevens, @sprottglobal.com. Or you can go to www.sprottmedia.com and sign up for our free newsletter blog called Sprott's Thoughts.
Yeah, you definitely want to get Sprott's Spots. If you don't already, it's free. You get the wisdom of Rick Rule, who is one of the smartest guys in the business here, who's always ahead of the cycle, it seems, at least in the time I've known him, past 7+ years, and has an opinion on everything. And whether you agree with it or not, it makes you think. So definitely go pick up a subscription to Sprott Spots. It's free. Just go to the site. Hey, while you're at it here, just send us an email. Tell us what you think. And try to do it so I get it first thing in the morning. That's when my mind is sharpest, where I've taken my first cup of coffee and then break into the emails, the Twitter feeds at Kerry Lutz, and the Facebook page, Financial Survival Network. Jason, it's always a pleasure to have you on. We're going to be watching these sectors carefully and closely. Good luck, and we'll talk to you again soon.
Thanks, Kerry.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.